Well, hello, clients, friends, and colleagues. Today is Tuesday, December 17th, and this is ARQ Wealth's new video format called 5 for 5. We're going to hit 5 market topics in 5 minutes. And we're going to start today by looking at the Dow Jones Industrial Average. By the way, this is Rich Siegel.
And this is Justin Rivera.
All right, Justin, let's get into it. I'll go first. Number one, the Dow is down now after today, 9 days in a row. That's the longest losing streak since 1978. How many years is that? Was that 46 years, huh?
Yeah.
It doesn't feel too bad though, right?
No, we're not down that much. You would
Right.
think that a 9-day losing streak would be down more than just 4%.
Yeah. About 4% off the high. We hit 45,000. So yeah, about 4% off the high. And the nice thing is it's gotten pretty cheap. The Dow is trading at about a 10% discount to the S&P 500's valuation. What you see in the Dow is a lot of these like energy companies and old school pharma like Pfizer and J&J.
Yep.
What's also interesting, let's go to number two.
Yeah, number two, one of maybe the newest. Is this the newest addition to the
Mhm.
Dow? Yeah, so added in early November, took out Intel. Fun fact about changes to the Dow, actually, only 58 times has the Dow changed in the 128 years of history for
Wow.
this index. So it's very rare that this happens. Might have something to do with some of the negative performance lately in the index, because as you can see, if you point, yeah, to that from November to December, it's been quite a bit of a drop, and especially in the latter half of December. Basically, a flat performance for Nvidia for the last 6 months.
Yeah.
It's it's definitely obviously one of the most important companies in the world, but maybe was trading a little bit on optimism rather than fundamentals.
I agree. And you'll see here that you're right. It's given back all the return for the last 6 months. 6 months ago, for the last 6 months, it's down 1%. So really it was an incredible performer. And sometimes when you're king of the mountain, you have nowhere to go but down. So yeah, so NVIDIA was added to the Dow in place of Intel. And the other change was with Dow Chemical, we're still down.
Sherwin-Williams, I believe.
Sherwin-Williams, right.
Yep. Yep.
Interesting, a paint company. Okay. All right, moving on. Number three, large cap versus small caps. We've been pounding the table on this for a while. Small caps look super attractive relative to large caps on a valuation basis. But here's the cool thing. As we head into 2025, the forecast for the Russell 2000 small cap index is 43% year over year earnings growth for the whole index, right? Incredible. And large and mid cap are both forecasted to grow at 15%, still very strong.
Still great. Still good.
Yep. And what's also interesting is that the small cap index is pretty heavy in the industrial sector, and also the financial sector, which really kind of lends to that Trump policy positions, onshoring, reshoring, and then deregulation. A lot of that happens in the financial sector. So we think that small caps may finally have their big day in the sun as we head into 2025.
Yeah.
And why don't you take us through number four?
Yeah, so this is just a value stock. It's a chart and a table. It's a little bit busy, so I'll walk us through this. But the main point of this is that value stocks after 10 consecutive down days, which over the last 50 years has not happened very often, but when it's happened, value stocks total return after 10 consecutive down days, when you look 12 months out, the percent of time that that's positive was 78% of the time. And the average return or the mean return in these different instances came out to around 21.9%. So we've been kind of pounding the table on value stocks and the fundamentals around it. This is a technical look at it. It's not, again, it doesn't have to do with the financial statements of the company. It doesn't have to do with the valuations. It's just from a pure technical aspect. There's a little bit of a tailwind to value stock performance over the next 12 months, which is great. And that's not something that we needed to see to feel great about it, but it is, like I said, an unexpected tailwind.
Yeah, great point. Yeah, it looks like it happened last in like 1996. So yeah, it's been
Been a
quite
long
a long
time.
time, right? All right, and finally, The final big piece of news here is tomorrow, the 18th, is the final FOMC meeting of 2024. And according to the betting markets, this is the Polymarket website right here, 97% chance of a 25 basis point decrease in interest rates. That would
So I
bring
guess we're gonna have an interest rate cut
probably, yeah.
then.
I think if they didn't do it, it'd be a huge surprise. The market might not like it very much.
Yep.
What this basically means is that from the high point of this hiking cycle, we'll be down to 4.5%, which is a full 1% or 100 basis points below where we were. I would say that that is still quite restrictive, right?
I would agree.
Yeah, CPI, Consumer Price Index inflation, is about 2.7 as of the end of November. So normally these numbers are pretty much in line. So what this basically means here is that the Fed is still being tight, not letting things run away. The surprisingly, the economy is looking pretty good. Everyone thought
Yeah.
we were going to have this recession, right?
Yeah, and I think because it's still looking, even with restrictive policy, it's still looking very good. That might lend itself to less cuts next year than we were expecting, and then the market was expecting just a few months ago.
Yeah, I think like a month or two ago, the forecast was for 4 cuts next year. Now we're hearing
Sure.
like things like 0 to 2. Um,
Yep.
and that's really because we don't need to cut if the economy is going to remain this strong. Well, we covered a lot in I think 5 minutes or less. So thanks for listening, everyone, and we'll speak to you soon.